Hello, welcome to another video from Fun Story. This is a FAQ series. We learned some concept in this series. So I thought that first we should educate our clients and subscribers about the basic concepts. Uh, Otherwise, just telling about the risks, returns, various other funds will have no value addition. So we'll tackle the question of what are good returns or what should be the expected returns from a mutual fund. So if someone asks us that what will be the return from a mutual fund, it's like asking the speed of a vehicle. So the speed can vary according to the road, according to the various vehicles. It may be a car which is good for a city, but may not be good in the highways. So it may be a truck which will take a lot of goods in it, which will carry a lot of goods. Then it may be a bike, it may be a sports bike also, it may be a SUV. So SUV can go in different terrains. So these vehicles will have various speeds based on the road, the weather, and the make of the vehicle also. So similarly, mutual funds also cater to various types of investors, and they invest in various asset classes. It's the concept that mutual funds invest in only equities is absolutely wrong. And even in equities, there are different types of schemes. So let's find out. So generally, people have the concept that mutual funds invest in share market. So those funds which invest in share market are called equity schemes. And in that they buy shares of companies like Reliance, HDFC, State Bank of India, or let's say TCS or Infosys. All these kind of companies they buy. Buying meaning the shares of these companies. So what does it signify? Buying into the shares of a company means you are taking part in the profits of the company. You are like the owner, part owner. So if the company makes profit, the price of that share will also go up in the longer run. So it's seen. I'm not going into discussion of that, but it is common sense that if a company makes a profit of, let's say, 10% per year for 10 years, then your share price will also be going up around 10%. It may go up by 12%, it may go up by 9%, but it will be near about the rate of profit of that company. But in the short term, the price fluctuations of these schemes will also be very high. Hence the expectation of return due to this risk. So let's find out. Okay, this is the HDFC equity fund. It is a very old fund. So let's see. See, we are taking a 7-year duration for this scheme. Okay, to see the returns. This red line is the return of this scheme. So if we see in around 2009 July, so the scheme from that period has steadily gone up, then gone a little bit down, and these are the fluctuations. It is going up and down and up and down. So still this is steady, and then from around 2013 it has shot up to 2015. So you see these for a long term time their returns have been not good. Then suddenly there has been a spike. That's why we recommend at least minimum 7 to 10 years of investment in any equity scheme. You see here there is a lot of volatility in this period. Then there is a upward move, then little bit down, then there is a steady upward move, and then this has been going up and down in a steady manner in this period. So If you go back a little bit, let's go back to, yeah, you see in this period, it has gone up straight in a straight line from around 2004 till 2008. That was the golden period of equities. There's a lot of movement in the shares of every company, so the fund has also moved up. Even in this bull run, there has been uh, ups and downs. You see, there's a, from 136 per unit, it has gone to 107. So it's around 25 to 30% decreases has been there even in this bull run. So that's why if one is investing in equities, he has to be sure that this kind of small ups and downs of 10-20% does not bother him. If his goal is around 7 to 10 years, then he should be sticking to that goal and aim. So, but from 2008, it has decreased to almost 50%. Then it has again increased. So you see there are a lot of volatility in this kind of schemes because they invest in the equities. If we go by annual returns, in 2007 it was 53%, then in 2008 it is almost down by 50%, then again next year it has gone up by 105%. So you see, whenever there is a downturn, it's better to put more money in the funds. Of course, this is like a one time investment that we are checking. It's not the SIP returns, so that we'll check in another video. So let's see the maximum and minimum returns. 179% has been the maximum returns for 1 year, that is 1998 October to October 1999. So if one had invested in 98 October, you'd have and held on for 1 year, you would have got 179% return. And the worst has been, suppose someone had invested seeing this return in 2007 December, and in 2008 December his return would have been minus 52%. So you should be careful while investing in these kind of schemes. You should better take the advice of your financial advisor. But if you see the 5 year, 7 year, 10 year returns, it is 12%, 14%, 7%. Here you do not see the fluctuation that I have shown you in the graph. So this is not reflected in this return. So one should be ready for this kind of ups and downs if you are investing in a equity scheme. But as you can see, over the long haul, it should give you a return which is higher than what we get from the traditional avenues of investment. Why we get that, we'll come to know about it. Okay, so next comes the other type of schemes that mutual fund invest in is the investment in bond market. These are called debt funds. So what they do is they lend to the government. So government borrows from these funds, and the companies like RIL, for example, Geo, they have borrowed a lot from the market. So some of it they have borrowed from the mutual funds also. So they are bound to pay the interest. Whether they make profit or loss is not the concern of the people who lend. So these mutual fund schemes will get interest from the government or the companies whom they lend. They may also get a profit or even loss from the sale of these bonds, because these bonds are traded in the market. Depending on the interest rates, they get a profit or loss also. So these are the two ways that they can make profit from the bond market, and these are called debt funds. So the difference between equity and debt is, in equities you will make money if your company makes profit, but in the debt market, even if the company is not making great profits, even if it is making 1% profit, but if the contracted rate of interest is 6%, 7%, they are bound to pay that interest to the mutual fund scheme. So they work in a similar fashion to fixed deposit, but the risk of this volatility from the bond market is always there, and sometimes there is another risk of default. That means the company may not be able to pay the interest also. So that risk is there. Of course, they do not lend to just any company. Obviously, they lend to the big companies in India, and of course, the government will not default. So we are taking a scheme HDFC Liquid Fund. It is an old scheme to drive home the point that this is one of the safest schemes, liquid schemes. So you'll see that there are no fluctuations like in the equity market. Then why should not people invest in these kind of funds only? Let's see. The worst return has been 0.29% in a month, and yearly the worst has been 4.24. There is no negative return in 1 year. So it is still higher than a savings bank account, and mostly the returns have been around FD rates. So why would people not invest in this kind of schemes? Let's see. And you see there is no fluctuation. If you see this red line, this has been steady rise. Although maybe in 10 years, maybe there will be 3 4 days where there might be negative returns. So it is not exactly a substitute for a savings bank account, because in savings bank account there will be no negative returns, but here there may be negative return, but for 1 day 2 days etc, around that period. It won't be like it will be negative for 3 months 4 months. So if one has extra money, then they can put here to earn a better return than a savings bank. So let's see, 7 years it's also 7.96, 10 years 7.76, 5 years 7.48, 3 years 6.92, 1 year is 7.23. So you see the volatility is very low in this kind of fund, and the returns are also low. That is the price we pay for lower volatility. While in the equity scheme, the 10-year returns were around 12%, 7 year around 14%. So for the risk, we are getting more returns. But in the short term, there may be even a 50% downward movement in prices in equity scheme. So this is a risk return matrix. Liquid funds are the lowest risk and lowest return, obviously. There are other debt funds which will have little bit higher risk and higher return. Here higher risk meaning that the price volatility in prices will be large. So suppose you want the money back in 1 year and it is giving a negative 1% return in 1 year, then it is the debt fund is not for you. Then you should go for a liquid fund. So if you are able to hold on for a little bit more time, then only you should invest in these kind of funds. Then if you have the more time you have, then you can go for the higher equity risky equity funds which have potential of higher returns also. The time should also be like this, it should increase as the risk increases. Now let's come to the concept of real rate of return. For that, we have to know the interest rates in the economy and the rate of inflation. Inflation is nothing but the general rise in prices of goods and commodities. Let's say we bought 1 kilo of rice at 50 rupees, and next year if that rice costs 55 per kg, that is the 10% rise in prices. That is 10% inflation. And interest is like, let's say, take the example of SBI FD rate in 2009. It was approximately 8%. It keeps on changing whenever the bank has more liquidity or the general rates in the economy is coming down or going up. So this kind of fluctuations goes around in FD rates also. But once it is contracted, you will get that amount for that duration of time. So it was approximately around 8%, but the inflation was around 14 to 15%. So you see, the inflation was very high. So what is the real rate of return? that is interest rate minus inflation. So if you are getting 8% while the goods and commodities prices of goods and commodities are increasing at 14 to 15%, then it is a negative real rate of return of 7%. That means if why should one put his money in a FD if the prices are rising more than the rate of FD? Current 10-year FD rate is 6.25% in SBI, while the inflation is around 3.5% to 4%. So still, as of now, we are getting a positive RRR of around 2.5 to 2.75%. So coming back to the returns from mutual funds, what should be our expectation? Our expectation should be this FD plus a certain percentage in the longer run. Let's say 10 year if you're investing for 10 years, we should expect around 6.25 plus around 3%, 4%. That should be the expectation. If it was 8% in this, so and inflation was 14%, then we should expect around 14% to compensate for the risk we are taking. And also the we are postponing our consumption by investing in a scheme. So see, the cost of postponement should be rewarded with a rate of return which is higher than the inflation. So these are the two uh, things that we should keep in mind, that the general rate of interest plus a certain return plus, in addition to that should be our expectation from mutual fund equity schemes. Of course, in if it is a FD, then the debt funds should also return approximately a little bit higher than FD. So that is how we should uh, take into consideration the return expectation. So thank you for watching this video. You can subscribe to our YouTube channel so that you get updates on our new videos. You can also subscribe to our Facebook channel. We'll keep the links in the comments box so that you can click and subscribe. Thank you for watching. Bye bye.